There is a version of Warren Buffett that you don't know. Before the folksy wisdom, before the billions in Coca-Cola and Apple, before he became the icon of long-term buy and hold forever investing, there was another Buffett. A younger man, hungry, operating out of a small office in Omaha, Nebraska. This Buffett was not a patient saint of value. He was a hunter, a mathematician of the market, a practitioner of an almost forgotten art that built his first real fortune. He was an arbitrageur, and the lessons from this forgotten chapter of his life are perhaps more important today than ever, because they offer a path to profit that has nothing to do with predicting the economy, guessing the direction of the stock market, or even believing in the long-term future of America. It is a strategy built on cold, hard mathematical certainty. A way of thinking that protects you from the single most costly mistake an investor can make, the belief that there is only one way to win. We have been taught to see investing as a grand narrative, a story of visionary companies and long-term growth. But in his early days, Buffett wasn't buying stories. He was buying probabilities. He was exploiting tiny cracks in the fabric of the market, moments of inefficiency, where profit was not a matter of opinion, but a matter of simple arithmetic. He was practicing the art of special situations investing, and understanding this lost chapter of his career will not just add another tool to your financial toolkit, it will fundamentally rewire how you see opportunity itself. It will provide you with a blueprint for generating market alpha that is independent of the chaotic whims of Wall Street, a method for wealth building grounded not in hope, but in logic. This is the story of how Buffett truly began, and it is the key to unlocking a level of financial sophistication that few ever achieve. The very foundation of this entire strategy, the genesis of Warren Buffett as a master of special situations investing, can be traced back to a substance that seems worlds away from the complexities of high finance: cocoa beans. In the mid-1950s, a young Buffett, managing his fledgling partnership, stumbled upon a peculiar situation involving a company called Rockwood & Company, a Brooklyn-based chocolate maker. It's an anecdote that reveals the core of his thinking, a foundational story that separates the arbitrageur from the ordinary speculator. Rockwood & Company had a problem, a very sweet problem. Due to the high price of cocoa beans at the time, the company found itself sitting on a massive inventory of the commodity that was worth a substantial amount of money, far more than was reflected in the company's stock price. The management, facing this unique situation, decided on a course of action that would have seemed bizarre to most investors. But to Buffett, it was a siren song of pure, unadulterated profit. The company announced it would use its valuable cocoa bean inventory to buy back its own stock. Now, for the average investor, this might sound like an odd piece of corporate news, perhaps a sign of trouble or a confusing bit of financial engineering. They would see the words cocoa beans and think about commodity prices, weather patterns in Ghana, and the fickle tastes of consumers. They would see volatility and uncertainty. Buffett saw a mathematical equation begging to be solved. The deal was this: Rockwood & Company offered to exchange its own shares for a specified quantity of cocoa beans. Buffett, with his mentor Benjamin Graham's teachings echoing in his mind, immediately did the math. He looked at the market price of Rockwood's stock. Then he looked at the market price of the cocoa beans the company was offering for each share. He discovered a significant discrepancy. The value of the cocoa beans being offered per share was materially higher than the price of a single share on the open market. This was not a bet on the future of the chocolate industry. This was not a forecast about the long-term demand for bonbons. It was a simple, beautiful arbitrage. A risk-free profit locked in by the company's own contractual offer. The path was clear. Buffett began buying shares of Rockwood & Company on the New York Stock Exchange. For every share he bought, he simultaneously sold the corresponding amount of cocoa beans short on the commodity futures market. He was locking in the price of the beans before he even owned them. Then, he would take his purchased shares, tender them to the company, and receive the physical cocoa beans in exchange. With the beans in hand, he would deliver them to the commodities broker to close out his short position. The difference between the higher price he had locked in by selling the beans short and the lower price he had paid for the stock was his profit. It was a cash machine. buy stock for X, sell beans for Y, and since Y was guaranteed to be greater than X, the profit was a near certainty. He repeated this process over and over. He wasn't just a passive investor. He was an active participant in a value-creating mechanism. He was, in essence, a human conversion engine, turning undervalued paper assets, the Rockwood shares, into their true, higher underlying commodity value. The rest of Wall Street was largely asleep at the switch. They were analysts, forecasters, storytellers. They wanted to know about Rockwood's brand, its management team, its 5-year plan. Buffett didn't care about any of that. He cared about the published terms of the exchange offer and the live prices on 2 different tickers. This single, elegant series of transactions netted his partnership a handsome, low-risk profit and became a cornerstone of his early success. It was a perfect demonstration of event-driven investing, where the catalyst for profit isn't a vague hope for future growth, but a specific, announced corporate event. In this case, the tender offer. This foundational anecdote is crucial because it contains the entire philosophy in miniature. It's about finding a gap between price and value that is set to close on a specific timetable due to a specific, observable event. It's about ignoring the grand, sweeping narratives of the market and focusing, with laser-like intensity, on the boring, contractual mechanics of a single special situation. This was the first flowering of a mindset that would later allow him to tackle far more complex situations, but the DNA was all there, in a pile of chocolate. The reason this type of opportunity even exists, and why so few people are equipped to seize it, lies deep within our own psychology. The human brain is a marvel of evolution, but it was not designed for the abstract, probability-driven world of modern finance. It was designed to survive on the savannah, and it is riddled with cognitive biases that make us terrible arbitrageurs. The primary psychological principle at play here is the profound human aversion to ambiguity and our desperate craving for certainty, or at least a narrative we can understand. When the average person hears about Rockwood & Company, their brain doesn't see a math problem. It sees a confusing story about a chocolate company. It starts asking questions rooted in forecasting. Will the price of cocoa beans go up or down? Is the chocolate business a good business to be in? These questions feel productive, but they are entirely the wrong ones. This is the brain's narrative bias in action. We are wired to process information in the form of stories, with causes and effects, heroes and villains. A simple arbitrage equation has no story. It's just numbers. It feels sterile, abstract, and deeply unsatisfying to our narrative-hungry minds. We prefer the exciting story of a hot tech stock that could change the world, even if its probability of success is minuscule, to the boring certainty of a 5% profit from a cocoa bean exchange. Compounding this is the bias for complexity. We tend to believe that complex problems require complex solutions. Wall Street feeds this bias with its endless jargon, its arcane analytical tools, and its legions of experts offering sophisticated forecasts. The Rockwood arbitrage was stunningly simple. It required basic arithmetic, not a PhD in finance. This very simplicity makes people suspicious. They think, if it were that easy, everyone would be doing it. They assume there must be a hidden risk, a catch they aren't seeing. This intellectual insecurity prevents them from acting on clear, simple opportunities. It is far more comforting to the ego to engage in a complex analysis of a company's 10-year discounted cash flow model, even if that model is built on a foundation of pure guesswork, than it is to simply buy a stock for $10 that a company has legally promised to buy back for $11 next month. The first feels like sophisticated investment analysis. The second feels like picking up money off the street, and our brains are conditioned to believe that there's no such thing as a free lunch. Buffett's genius was in his ability to override this ingrained programming. He possessed a profound intellectual humility. He didn't believe he could predict the future price of cocoa beans or the long-term prospects of the chocolate industry. What he did believe in was the binding nature of a corporate tender offer and the accuracy of the prices quoted on the stock and commodity exchanges. He chose to play a game of certainty in a world where everyone else was playing a game of prediction. This is a fundamental psychological shift. It's the move from thinking like a forecaster to thinking like a plumber, looking for leaks and pressure differentials in the system that can be exploited with the right tools. It's about silencing the storyteller in your head and awakening the mathematician. So how can we, today, apply this same mental model? How do we translate the Rockwood & Company story into a practical blueprint for our own financial decision-making? The first step is to adopt what can be called the certainty first framework. This is a mental filter you apply to every potential investment or business decision. It forces you to categorize opportunities not by their potential upside, but by the nature of their underlying profit driver. The framework has 3 simple layers. Layer 1 is speculation. This category includes almost everything the average person thinks of as investing. Buying a stock because you think it will go up, investing in a startup because you believe in its vision, buying a cryptocurrency because it has momentum. The profit in these cases depends on correctly predicting the future behavior of other people or the market at large. Your success is contingent on a story coming true. Under the certainty first framework, you acknowledge these as speculations and treat them with extreme caution. Layer 2 is value investing. This is the classic Buffett approach everyone knows. You analyze a business, determine its intrinsic value, and buy it for a significant discount to that value. Here, your profit depends on your analysis being correct and the market eventually recognizing that value. There is more logic here than in pure speculation, but it still relies on a future event, market recognition, that has no fixed timetable. It is a probabilistic bet on value, but not a bet on a certain event. Layer 3, the core of our discussion, is contractual certainty. This is the domain of arbitrage and special situations. You actively seek out opportunities where the profit is not dependent on market sentiment, economic growth, or your own brilliant forecast. Instead, the profit is embedded in a contract, a legal filing, a tender offer, a liquidation plan. The question you must ask is not, what do I think will happen, but what has someone legally promised will happen? To put this into practice, your first action is to change your information diet. Stop spending all your time on financial news channels that peddle narratives and speculation. Instead, start learning to read the sources of contractual certainty. This means spending time on the SEC's Edgar database, reading filings like the 14D9, a company's recommendation on a tender offer, or the DEFM 14A, a definitive merger proxy statement. These documents are dense and boring, which is precisely why they contain so much opportunity. They are the blueprints of corporate events. The second step is to build a simple screening process. You can set up alerts for keywords like merger agreement, tender offer, liquidation, or spin-off. When one of these events is announced, your job is not to have an opinion on the strategic merit of the deal. Your job is to become an accountant. You pull out the documents, you find the numbers, and you calculate the spread. Is the company being acquired for $50 a share in cash, and is it trading at $48? If so, there is a $2 spread. The final step is to ask the arbitrageur's primary question: what can go wrong? You are not looking for reasons the deal will succeed. You are looking for specific, identifiable obstacles that could cause it to fail. Regulatory approval? Shareholder vote? Financing conditions? You systematically go through the checklist of potential deal breakers. By filtering the world through this certainty-first framework, you completely invert the typical investment process. You start with the most certain, mathematically verifiable opportunities, and only then move down the pyramid to more speculative bets, if at all. This disciplined approach to financial education and investment analysis is the first and most critical step in walking the path of the young Buffett. Of course, the vast majority of people, the 99%, do the exact opposite. Their path is the antithesis of this calculated, logical approach. The path of the 99% is governed by emotion, narrative, and social proof. It is the path of the gambler's mindset. The gambler walks into the casino of the market not with a calculator but with a vague feeling of hope and a susceptibility to good stories. They hear about a stock on the news or from a friend at a barbecue. The story is always compelling. A new technology that will change the world, a drug that will cure a disease, a retail brand that has captured the zeitgeist. There is no spread to calculate, no legal document to analyze. There is only the intoxicating allure of a massive, undefined upside. This is a lottery ticket, not an investment strategy. This mindset is fueled by the fire of FOMO, the fear of missing out. They see a stock rocketing upward and feel a visceral panic that they are being left behind. They buy at the top, driven by the herd, with no understanding of the underlying value or the business itself. Their entry point is determined by social proof, not by independent analysis. When the inevitable correction comes, they are the first to panic and sell, locking in devastating losses. They bought a story, and when the story changed, they had no other anchor. The arbitrageur, in contrast, is immune to FOMO. The price of a stock in a merger arbitrage situation might barely move for months. It is boring. It does not offer the dopamine hit of a soaring tech stock. This very boredom is its virtue, as it repels the gamblers and leaves the field open for the disciplined practitioner. Furthermore, the 99% are what we might call single-factor investors. They bet on one thing, that the price will go up. Their entire thesis is number go up. The special situations investor has a multifaceted thesis. Their profit is contingent on a deal closing. Their risk is the probability of that deal failing. They have a clearly defined upside, a clearly defined downside, the price the stock will fall to if the deal breaks, and a timeline. The gambler has none of this. They have no concept of risk management beyond the vague hope that they can sell to someone else at a higher price, the greater fool theory of investing. When a gambler's bet goes wrong, it is a catastrophic failure of their entire premise. When an arbitrageur's bet goes wrong, if a deal unexpectedly breaks, it is a calculated and planned-for statistical outcome. They might lose 15 or 20% on that one position, but because they have sized their positions correctly and have a portfolio of many such deals, the loss is a manageable data point in a profitable system, not a soul-crushing event. The disastrous consequence of the gambler's mindset is not just the loss of money, it is the complete destruction of a coherent process. It leads to a cycle of hope and fear, boom and bust, that ultimately convinces people that investing is just too risky, causing them to retreat from the markets altogether and miss out on decades of potential wealth building. They blame the game, when in fact they were simply playing the wrong one. The financial connection here is profound and directly impacts your ability to achieve financial freedom. The strategy of special situations investing, at its core, is a tool for creating uncorrelated returns. This is a critical concept that separates amateur portfolio management from professional wealth management. Most investors, whether they realize it or not, have a portfolio that is highly correlated to the general market. They own a collection of stocks, perhaps in an index fund. When the stock market has a good year, they do well. When the stock market has a bad year, they do poorly. Their financial fate is tethered directly to the whims of the S&P 500. An arbitrage portfolio, however, behaves differently. The profit from a merger arbitrage deal closing does not depend on whether the Federal Reserve raised interest rates or what the latest GDP numbers are. It depends only on the specific terms of the deal being met. Therefore, you can have a year where the overall market is down 20%, but a portfolio of successful arbitrage deals can still be up 10%. This is the holy grail of portfolio diversification. This has a tangible effect on your financial statements, specifically on the volatility of your portfolio. Volatility is a measure of risk. A portfolio that swings wildly up and down is riskier and more psychologically taxing than one that grows more smoothly. By adding a sleeve of uncorrelated event-driven strategies, you can dramatically lower the overall volatility of your entire net worth. This improves what finance professionals call your Sharpe ratio, a measure of risk-adjusted return. A higher Sharpe ratio means you are getting more return for each unit of risk you take on. This is the secret of many of the world's most successful hedge funds. They aren't necessarily trying to hit home runs. They are trying to build robust, all-weather portfolios that can generate returns in any market environment. By thinking like an arbitrager, you are essentially creating your own private miniature hedge fund strategy. You are building a financial engine that has a different fuel source from everyone else's. While their engines stall when the economic weather turns sour, yours keeps running, powered by the constant, ongoing process of corporate change. This financial advantage is not trivial. Over a lifetime of investing, the ability to generate returns even when the market is falling is the difference between a comfortable retirement and true, generational wealth building. It is the ultimate financial transformation, the shift from being a passenger on the market's roller coaster to being the operator of your own, much more predictable, financial machine. Once we understand the basic principle of arbitrage, we can delve into its most common and accessible form, merger arbitrage. This is the bread and butter of the event-driven investing world. The anatomy of this play is elegant in its simplicity. A company, let's call it Acquirer Corp., publicly announces its intention to buy another company, Target Corp., for a specific price, say $100 per share in cash. At the moment of the announcement, Target Corp's stock, which might have been trading at $75, will immediately jump in price. However, it will almost never jump to the full $100. It might, for instance, jump to $96. That $4 difference between the deal price, $100, and the current market price, $96, is called the merger spread, and within that spread lies the arbitrager's profit. The existence of that spread is the entire reason this strategy works. It exists because no deal is ever 100% certain until the moment the cash hits the bank accounts of the shareholders. There is always a small but real risk that the deal could fall apart. It could be blocked by regulators, voted down by shareholders, or the acquirer could fail to secure financing. That $4 spread is the market's payment to you for bearing that risk over the time it takes for the deal to close. A young Warren Buffett understood this calculus better than anyone. He treated these spreads not as gambles, but as actuarial tables of risk. A fantastic illustration of this mindset, though it comes from later in his career, was his investment in the Dow Jones & Company acquisition by Rupert Murdoch's News Corp in 2007. The story of this deal is a masterclass in analyzing a special situation. News Corp made an offer to buy Dow Jones, the publisher of the Wall Street Journal, for $60 a share. This was a massive premium to where the stock had been trading. The deal was controversial. The Bancroft family, who controlled Dow Jones through a special class of voting shares, were deeply divided. Many members of the family were philosophically opposed to selling their journalistic crown jewel to a figure like Murdoch. The financial media was filled with dramatic stories of family feuds, last-minute holdouts, and the potential for the deal to collapse. The stock, reflecting this uncertainty, traded at a significant discount to the $60 offer price. For the average investor, this was a soap opera. It was a story about family legacy and journalistic integrity. For Buffett, it was a math problem with a psychological overlay. He began buying shares, not at the full $60, but at the discounted price the market was offering. He wasn't betting on Murdoch. He was betting on the predictable nature of human self-interest. He calculated that despite their public reservations, a sufficient number of the younger, less sentimentally attached Bancroft family members would ultimately find the massive premium of the $60 cash offer too tempting to refuse. They would, in the end, vote with their wallets. He was assessing the probabilities. He read the proxy statements, understood the family's voting structure, and made a calculated wager that the forces of finance would overcome the forces of tradition. He wasn't guessing. He was using his deep understanding of business and human nature to handicap the odds. And he was correct. The deal was eventually approved, and the stock price converged to the $60 buyout price. Everyone who held the shares received $60 in cash from News Corp. For those who bought at, say, $55, it was a simple, clean profit, realized in a matter of months. This profit had absolutely nothing to do with Dow Jones's advertising revenue that quarter or the number of subscribers to the Wall Street Journal. It was earned solely because a publicly announced corporate event, the merger, was successfully consummated. This is the quintessential merger arbitrage play. It requires the discipline to ignore the dramatic headlines and the ability to focus on the underlying mechanics of the deal: the price, the terms, the key players, and the probability of completion. It is a perfect example of how advanced investing strategies are often less about complex financial modeling and more about clear-eyed, probabilistic thinking. The psychological principles that make merger arbitrage a consistently profitable strategy are deeply rooted in some of the most powerful biases that affect human decision-making. The primary driver of the merger spread is fear, and that fear is amplified by a cognitive bias known as the availability heuristic. This heuristic describes our tendency to overestimate the likelihood of events that are more easily recalled in our memory. When it comes to mergers, the events that are most memorable are the ones that fail spectacularly. The media loves a good story of a collapsed deal. Headlines scream about regulatory roadblocks, shareholder rebellions, and last-minute collapses at the corporate altar. These dramatic, high-profile failures are vivid, easily recalled, and thus, our brains trick us into thinking they are far more common than they actually are. The quiet, successful completion of 95 out of 100 deals goes by with little fanfare. But the 5 that implode become front-page news, creating a lasting impression of risk and danger. The arbitrageur's advantage comes from ignoring this mental shortcut. They don't rely on memory or media headlines to assess risk. They rely on data. They look at the base rates. They study the historical statistics of deal completions. They know that historically, once a friendly merger deal is formally announced with a definitive agreement, the vast majority, often upwards of 90 to 95%, are successfully completed. The arbitrageur uses this statistical reality to systematically bet against the public's irrational fear. While the average investor is paralyzed by the vivid, available image of a failed deal, the professional is calmly calculating the real, much lower probability of failure. Another powerful bias at play is what psychologists call ambiguity aversion. People prefer known risks over unknown risks. A merger that is pending regulatory approval presents an unknown risk. Will the Department of Justice approve it? Will European regulators? We don't know for sure. This ambiguity is uncomfortable, and most investors will demand a higher potential return, a wider spread, to compensate them for this discomfort. Buffett and investors like him have a high tolerance for this kind of ambiguity because they do the work to make it less ambiguous. They don't just see a black box labeled regulatory risk. They study previous rulings, they learn about the specific antitrust concerns, and they try to quantify the probability of approval. They do the hard, boring work of transforming an unknown risk into a known, calculated risk. By doing so, they are able to earn the premium the market pays for ambiguity aversion. The successful practice of merger arbitrage is therefore a form of psychological jujitsu. It uses the market's own fear, its own cognitive biases, and its own aversion to complexity against itself to generate consistent, low-risk profits. It's a game played not on the balance sheet but in the minds of the market participants. To translate this theory into a practical, applied mental model, you need to develop an arbitrageur's checklist. This is a rigorous, step-by-step process for analyzing any potential merger arbitrage situation. It removes emotion and ensures you examine every critical aspect of the deal before risking a single dollar. Step 1. Deal identification and spread calculation. This is the starting point. You identify a publicly announced merger. The key is that it must be a definitive agreement, not just a rumor. You then find the offer price and the current market price of the target company's stock. The calculation is simple. Offer price, current price, current price. This gives you the total spread. For example, if the offer is $100 and the stock is at $96, the spread is $100 to $96/$96, which is approximately 4.17%. Step 2. Analyze the deal terms. Is it an all-cash deal? This is the simplest and safest form of arbitrage. Is it an all-stock deal? This is more complex. You are exchanging shares of the target company for shares of the acquiring company. This means you are now exposed to the price fluctuations of the acquirer's stock. To hedge this, a professional arbitrager would short the acquirer's stock against their long position in the target stock. Or is it a mix of cash and stock? You must analyze the exact terms to understand your true exposure. Step 3. Assess the probability of closure. This is the heart of the analysis, and where skill and judgment come in. You must investigate the key potential hurdles. First, regulatory risk. Is this a merger of two giants in the same industry that is likely to draw antitrust scrutiny? You need to research the FTC and DOJ's stance on market concentration in that specific sector. Second, shareholder approval. Read the proxy statements. Are there major institutional shareholders who have spoken out against the deal? Is there a competing bidder who might emerge? Third, financing. Does the acquirer have the cash on hand, or are they relying on raising debt? If it's the latter, is there a financing out clause that lets them walk away if they can't get their loan? Each of these questions must be answered by digging into the deal documents. Step 4. Calculate the annualized return. A 4% spread might not sound exciting, but you must consider the time frame. If the deal is expected to close in 3 months, that 4% return becomes much more attractive. The formula is 1 plus total spread caret 365 days to closing 1. A 4.17% return in 90 days, for example, annualizes to a stunning 17.7%. This calculation allows you to compare different arbitrage opportunities on an apples-to-apples basis. Finally, Step 5. Position sizing. No matter how certain a deal seems, you never bet the farm. You decide how much capital to allocate based on your assessment of the risk. The higher the perceived risk of a deal break, the smaller your position should be. A portfolio of 15 to 20 different merger arbitrage positions, each a small percentage of your capital, is a far more robust approach than making one large bet. Following this checklist transforms you from a speculator into a risk analyst. It provides the structure needed to execute this advanced investing strategy with discipline and precision. The antithesis to this methodical process is the path of the 99%, embodied by the naive buy-the-rumor speculator. This individual represents the most common and most costly approach to merger-related events. They operate entirely on headlines, rumors, and tips. They might read a blurb on a financial news website that says, "Company X is rumored to be a takeover target." Without any further research, they jump in and buy the stock. They have no idea what a potential price might be. They have no understanding of the company's standalone value. They are simply buying the rumor, hoping to sell on the news. This is not investing. It is a game of hot potato with your own capital. This speculator is driven by a desire for easy, fast money. They are drawn to the excitement of a potential buyout, the thrill of getting in on the ground floor. Unlike the arbitrageur who enters after 2p as a deal is announced and plays for a small, high-probability spread, the speculator gets in before 2p people any announcement, playing for a massive, low-probability lottery ticket. They might get lucky once or twice, reinforcing their bad habits, but over the long run, this strategy is a guaranteed loser. More often than not, the rumors prove false, and the stock drifts back down, leaving the speculator with a loss. Even if a deal is eventually announced, the speculator's lack of discipline continues to hurt them. Let's say the rumor they bought into at $60 a share proves true, and an acquirer offers $75. The stock jumps to $72. The arbitrageur might now enter the scene, buying at $72 to capture the final $3 spread. The speculator, however, is now anchored to their initial excitement. They might think, if they offered $75, someone else might offer $85. They get greedy. They hold on, hoping for a bidding war that may never materialize. Then, perhaps the deal hits a minor regulatory snag. The stock temporarily drops from $72 to $68. The speculator, who has no framework for analyzing this news, panics. Their entire thesis was based on positive momentum, and now that momentum has reversed. They sell at $68, locking in a modest profit but leaving significant money on the table. Or worse, if they bought at a higher price, locking in a loss. They lack the emotional fortitude that comes from a rigorous, checklist-driven process. The arbitrageur, in contrast, would see the drop to $68, reevaluate the regulatory risk, and if their analysis shows the risk is still low, they might even buy more, as the annualized return has now increased. The speculator is a passenger on a roller coaster of emotion. The arbitrageur is a pilot, calmly navigating based on their instruments and flight plan. The ultimate consequence for the speculator is not just financial loss, but a complete misunderstanding of how wealth is truly built. They forever chase the big score, the one magic stock, while the arbitrageur patiently lays brick after brick, building a fortress of capital one small, near-certain profit at a time. The direct financial connection of mastering merger arbitrage is the ability to generate a quantifiable and predictable stream of market alpha. Alpha is the return an investment generates that is above and beyond the return of the market benchmark. It is a direct measure of skill. For most investors, achieving consistent alpha is nearly impossible. With merger arbitrage, it is built directly into the mathematics of the strategy. Let's take our example. A deal is announced at $100 per share, and the stock is trading at $96. The deal is expected to close in 120 days. Your total potential profit, or spread, is $4 per share. Let's say your rigorous analysis leads you to believe there is a 95% chance of the deal succeeding and a 5% chance of it failing. If it fails, you estimate the stock will fall back to its pre-deal price of $75, representing a loss of $21 per share, $96 to $75. Now you can calculate your probability-weighted expected return. There's a 95% chance of making $4 and a 5% chance of losing $21. The math is 0.95 $4, 0.05 $21 equals $3.80 minus $1.05 equals $2.75. This is your expected profit per share on a probability-weighted basis. This is a positive expected return, making it a good bet. This single calculation is more valuable than 100 analyst reports that say, "We think this stock is a buy." It quantifies your edge. Now, let's consider the impact on your portfolio. Imagine you build a portfolio of 20 such deals, all with similar positive expected returns. Some might close faster, some slower. One out of the 20 might even fail, resulting in a loss. But because the other 19 succeed, the overall portfolio generates a positive, predictable return. Let's say the average annualized return on your successful deals is 15%. Even with one deal failing and causing a drag on performance, your overall arbitrage portfolio might return 10 to 12% for the year. If the stock market that year is flat or down, that 10 to 12% is pure alpha. It is a direct, tangible financial advantage created by your skill and discipline. This is how sophisticated wealth management entities think. They don't just buy assets, they manufacture returns by identifying and exploiting these types of structural market inefficiencies. For an individual investor, dedicating even a small portion of a portfolio, say 10 to 20%, to these alternative investments can have a dramatic impact. It creates a source of return that zigs when the rest of the market zags, smoothing out your equity curve and reducing your dependence on the broad economic cycle. This isn't just a clever trick. It is a fundamental pillar of sophisticated portfolio diversification and a direct path to more resilient and rapid wealth building. While merger arbitrage is the most well-known form of special situations investing, it is only one chapter in a much larger book. The true genius of the arbitrage mindset is its ability to find profit in any form of corporate upheaval or restructuring. Buffett's playbook extended far beyond simple buyouts into the hidden world of spin-offs, liquidations, and what he called workouts. These opportunities are often more complex and less visible than a public merger, and for that reason, they can be even more profitable for those willing to do the analytical detective work. The quintessential example of this from Buffett's early partnership is the story of the Sanborn Map Company. It is an anecdote that reveals a deeper level of special situations thinking, one that goes beyond profiting from a single event and moves toward actively forcing value to be unlocked. In the late 1950s, Sanborn Map had what appeared to be a dying business. They produced incredibly detailed, book-bound maps of cities used by insurance companies to assess fire risk. But with the advent of new technologies, the core map business was in a slow, terminal decline. The stock price reflected this gloomy outlook, trading at a low valuation that suggested the company was on its way to irrelevance. Most investors saw a buggy whip manufacturer in the age of the automobile and turned the page. But Buffett, trained by Ben Graham to look at a company not as a story but as a collection of assets, decided to look under the hood. He pulled the company's annual report, and what he found was astonishing. For decades, Sanborn Map had been taking the profits from its map business and investing them in a portfolio of stocks and bonds. Over time, this investment portfolio had grown to be enormous. Buffett did the simple math. He calculated the value of Sanborn's investment portfolio per share. He found that the value of the stocks and bonds alone was worth about $65 for every share of Sanborn Map stock. The market, however, was only pricing Sanborn stock at $45 per share. This meant that by buying the stock at $45, he was essentially getting the entire map-making business, the buildings, the printing presses, the copyrights, for less than nothing. He was paying 45 cents for 65 cents worth of blue-chip stocks and getting a whole company thrown in for free. This was a classic cigar butt investment, but with a crucial difference. It wasn't enough to just buy the stock and wait. The management was entrenched and had shown no interest in unlocking the value of the investment portfolio for shareholders. The value was trapped. So Buffett didn't just invest. He became an activist. He started buying up a significant portion of the company's shares, enough to get a seat on the board of directors. Once on the board, he began to agitate, persuading other board members that the status quo was absurd. He argued that the company should separate the investment portfolio from the map business and distribute its value to the shareholders. Eventually, he succeeded. The company agreed to use the investment portfolio to buy back shares at a price close to its fair value. Buffett and his partners made a roughly 50% return on their investment. This wasn't merger arbitrage, it was a workout. He identified a massive gap between price and intrinsic value and then supplied the catalyst himself to force that gap to close. It demonstrates a level of investment analysis that is proactive, not passive, and it opens up a whole universe of opportunities beyond simple, event-driven investing. The psychological reason these opportunities, particularly in cases like spin-offs, exist is due to a powerful combination of the status quo bias and a phenomenon known as mental accounting. The status quo bias is our innate preference for the current state of affairs. Any change from that baseline is perceived as a loss or a risk. When a large, well-known company like, say, General Electric announces it is spinning off its healthcare division into a new, independent company, investors in GE are faced with a change. They will receive shares in this new, unfamiliar entity. Their comfortable, stable holding in good old GE has now become more complex. Many investors, particularly large institutions with specific mandates to only own, for example, S&P 500 stocks, will react to this change by immediately selling the shares of the new spin-off, which is often too small to be in the index. They sell not because they have done any analysis on the new company, but simply because it is different and disrupts their status quo. This is called indiscriminate selling, and it is a gift to the special situations investor. This is compounded by mental accounting. This is our tendency to place different values on money depending on its source or our intention for it. An investor might receive shares in a spin-off that constitute only 2% of their original position's value. In their mind, they categorize this small holding as nuisance stock. It's too small to keep track of, it clutters up their portfolio statement, and the commission to sell it might feel disproportionately high. So they sell it just to clean up their account. They are not making a rational investment decision about the company's future prospects. They are making an emotional, administrative decision. This creates a situation where, in the first few weeks and months of a spin-off's life as a public company, there is immense artificial selling pressure that has nothing to do with its underlying value. The stock is often pushed down to absurdly low valuations simply because its initial owners don't want it. This is a perfect hunting ground for the discerning investor. They understand that the former parent company often has every incentive to set the spin-off up for success, with a clean balance sheet and a focused management team. While the crowd is selling for non-economic reasons, the arbitrageur is buying, knowing that once this initial wave of indiscriminate selling subsides, the company's true fundamentals will have a chance to shine, often leading to a significant re-rating of the stock price. To capitalize on these more complex situations, we need an applied mental model that goes beyond the merger checklist. We need the sum of the parts valuation blueprint. This is a way of thinking that is core to many private equity and hedge fund strategies. It involves dissecting a company and valuing its constituent pieces as if they were standalone businesses. Step 1 is to identify targets. You look for companies that are complex, often labeled as conglomerates, which operate in multiple unrelated industries. These companies are often misunderstood by Wall Street analysts who specialize in a single sector and find it difficult to properly value a business that spans, for example, aerospace, insurance, and medical devices all at once. This complexity often leads to a conglomerate discount, where the market values the company at less than the sum of its individual parts. Step 2 is the valuation work. This is the most analytical part of the process. You must build a separate valuation model for each major division of the company. You would value the aerospace division by looking at the multiples of other pure-play aerospace companies. You'd value the insurance division using metrics appropriate for insurance companies. You do this for every significant business segment. This requires diligence and a willingness to learn about different industries. Step 3 is the summation and comparison. Once you have a credible, conservative valuation for each part, you add them all up. Then, you subtract the company's total corporate debt. The number you are left with is your estimate of the company's private market value or intrinsic value. The final step is to compare this number to the company's current market capitalization. If your calculated sum of the parts value is, say, $150 per share, and the stock is currently trading at $90 per share, you have identified a potential Sanborn map-style opportunity. The key, however, is that identifying the discount is not enough. You also need a catalyst. What will force the market to recognize this hidden value? This is where you look for clues. Is there a new activist investor involved? Has the CEO recently talked about portfolio optimization or strategic alternatives? Is there pressure from shareholders to simplify the business? The combination of a significant discount to the sum of the parts value and a credible potential catalyst is the signal to act. This mental model forces you to see through the noise of a consolidated income statement and view a company as a portfolio of assets, which is the first step toward thinking like a true owner and a sophisticated capital allocator. The antithesis of this deep analytical approach is the headline investor. This individual's entire understanding of corporate strategy is derived from the shallow narratives presented by mainstream financial media. They are a creature of surface-level interpretation. When they see a headline that says, "Conglomerate ABC to spin-off industrial division," their immediate reflexive thought is negative. They interpret this action as a sign of weakness. They think, they must be selling off the division because it's a bad business. Or, this restructuring is a sign of desperation. They see complexity and corporate action and equate it with trouble. Without doing any of the underlying work, they sell their shares, often at the exact moment of maximum pessimism when the indiscriminate selling pressure is at its peak. This headline investor confuses activity with failure. They don't understand that a spin-off can be an incredibly bullish event, freeing a great business from the bureaucratic bloat of a large parent company. They don't understand that a liquidation might be the most rational path to realizing the full value of a company's assets for shareholders. Their thinking is a mile wide and an inch deep. They react to the news, but they never read the source documents. They have an opinion on the strategy, but they have never done a sum-of-the-parts analysis. The disastrous consequence of this superficial approach is that the headline investor is perpetually on the wrong side of the value trade. They sell spin-offs to the arbitrageurs at bargain basement prices. They unload shares in a complex company just before an activist investor arrives to unlock massive value. They are, in essence, the source of liquidity for the smart money. Their emotional, headline-driven reactions create the very inefficiencies that the special situations investor profits from. They are playing a game of checkers on a board where their opponents are playing three-dimensional chess. Over a lifetime, this approach not only leads to poor returns, but also to a state of permanent confusion. The market seems random and unpredictable to the headline investor because they have never taken the time to understand the underlying machinery of corporate finance that drives it. They are forever trapped in a cycle of reacting to the shadows on the wall, without ever turning around to see the substance that is casting them. The direct financial connection of mastering this broader universe of special situations is the ability to unlock hidden balance sheet value. A company's financial statements, particularly its balance sheet, are a numerical representation of its assets and liabilities. For most investors, it's just a static document. For a special situations expert, it's a treasure map. The sum of the parts analysis is the process of decoding that map. Consider a hypothetical company, Global Corp. Its stock trades at a market capitalization of $10 billion. On the surface, it looks like a single cohesive $10 billion entity. But you do the work. You discover it has three divisions. Division A is a fast-growing software business that, if it were a standalone company, would likely trade for 8 times sales, valuing it at $7 billion. Division B is a stable, cash-generating industrial business that would trade for 10 times earnings, valuing it at $6 billion. Division C is a legacy business that is breaking even, worth maybe $1 billion in liquidation. The sum of the parts is $7 billion plus $6 billion plus $1 billion equals $14 billion. The company has $2 billion in debt, so the equity is worth $12 billion, yet the market is pricing the entire company at only $10 billion. There is $2 billion of hidden, unlocked value on the balance sheet. As a special situations investor, you can buy the stock at the $10 billion valuation and then profit as that value is unlocked. The catalyst could be the spin-off of the software division. The moment it becomes a separate company, the market is forced to value it on its own merits, and it likely re-rates to its proper $7 billion valuation. Or the catalyst could be the sale of the legacy division for $1 billion. That cash goes onto the balance sheet, making the company's underlying value more apparent. In each case, you are profiting from a re-evaluation of the company's assets, forcing the market price to converge with the underlying balance sheet reality. This is a profoundly different way of generating returns than betting on future earnings growth. You are not betting on the company inventing a new product. You are betting that the market will be forced to correctly add up the assets that the company already owns. This approach allows you to generate significant market alpha by being a financial archaeologist, uncovering the value that is already there, buried under layers of complexity and investor indifference. It's a direct, measurable, and powerful engine for wealth building that is available to anyone willing to learn how to read the map. Of course, the central question that hangs over all of these strategies is risk. What happens when a deal goes wrong? What happens when the merger is blocked, the liquidation yields less than expected, or the spin-off stock plummets? This is the fear that paralyzes most investors and keeps them on the sidelines. But for the professional, risk management is not an afterthought. It is the very core of the entire process. The key is not to avoid losses, which is impossible, but to ensure that your wins are significantly larger and more frequent than your losses. Warren Buffett's entire philosophy is built upon a margin of safety. In value investing, this means buying a stock for far less than its intrinsic value. In special situations, this margin of safety is found in probabilities. It's about structuring your bets so that you have a significant probabilistic advantage. The foundational anecdote here is not a single, spectacular deal, but rather the deals Buffett didn't do. His discipline in saying no is far more instructive than his brilliance in saying yes. Throughout his partnership letters, he frequently discussed quotes, workouts, or arbitrage situations he analyzed and then passed on. He would write that the potential return was, say, 20%, but the risk of failure meant a potential 50% loss. The spread was attractive, but the risk/reward profile was skewed against him. He put it in the too hard pile and moved on. Imagine how he would have analyzed a high-profile failed deal, like the attempted merger of telecom giants AT&T and T-Mobile in 2011. AT&T offered to buy T-Mobile for $39 billion. This was a massive deal that would have consolidated the U.S. wireless market from 4 major players to 3. The initial spread was attractive. However, the antitrust risk was enormous and obvious from day one. The Department of Justice and the Federal Communications Commission had repeatedly expressed concerns about a lack of competition in the wireless industry. A novice arbitrager, seduced by the high annualized return offered by the wide spread, might have jumped in. But a disciplined practitioner following Buffett's principles would have immediately focused on this glaring red flag. They would have placed the probability of regulatory approval far, far lower than in a typical deal. Buffett's approach would be to assess the downside first. In the merger agreement, there was a substantial breakup fee that AT&T would have to pay T-Mobile if the deal failed. This fee provided some downside protection for T-Mobile's stock, but it wouldn't prevent a significant drop. The disciplined analysis would conclude that the risk of a 30 to 40% loss if regulators blocked the deal was simply too high, even if there was a 50% chance of making a 15% gain. The probabilistic equation didn't work. The potential for a catastrophic loss outweighed the likelihood of a modest gain. Indeed, regulators did block the deal, and T-Mobile's parent company, Deutsche Telekom, saw its stock fall significantly. The investors who had ignored the obvious regulatory risk were wiped out. The investors who followed a disciplined, probability-driven process like Buffett were safely on the sidelines, their capital preserved for a better opportunity. The most important part of this low-risk investing strategy is not picking the winners, but ruthlessly avoiding the losers. The psychological demons that lead to ruin in these situations are loss aversion and its close cousin, the endowment effect. Loss aversion, a concept proven by psychologists Daniel Kahneman and Amos Tversky, describes the fact that for most humans, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. A $1,000 loss feels as bad as a $2,000 gain feels good. When an arbitrager buys a stock in a deal that starts to go south, perhaps a regulator expresses concerns, this loss aversion kicks in with a vengeance. The stock might drop 10%. The unrealized loss is intensely painful. The amateur investor, unable to bear this psychological pain, might either sell in a panic or, worse, freeze up. This is where the endowment effect comes into play. This bias causes us to overvalue something simply because we own it. That stock we bought is now our stock. We become attached to it. We don't want to admit we made a mistake and sell it for a loss. So we start to rationalize. We tell ourselves, the regulators are just posturing, or it's a minor setback, the deal will still go through. We fall in love with our position and refuse to see the facts that are screaming at us. This emotional attachment prevents us from cutting our losses rationally. Buffett's mind works differently. He has trained himself to fight these biases. He thinks in terms of probabilities and expected outcomes, not in terms of emotional attachment or the pain of loss. If the facts change, his opinion changes. If the probability of a deal closing drops from 90% to 50% because of a negative regulatory ruling, he doesn't hope for the best. He reruns the math. The new probability-weighted outcome is likely negative. So he sells. He takes the small loss immediately and moves on. He feels no emotional attachment to the stock. It is simply a mathematical instrument. He has said, "The most important thing to do if you find yourself in a hole is to stop digging." The amateur, driven by loss aversion and the endowment effect, keeps digging, hoping to find treasure. The professional knows the hole is barren, cuts their loss, and walks away to find a more fertile piece of ground. This emotional discipline is not a personality trait. It is a learned skill, forged through a deep understanding of one's own psychological frailties. The applied mental model for building this discipline is the pre-mortem and downside capping framework. It is a systematic way to manage risk before you ever enter a position. Step 1 is the pre-mortem. Before you buy a single share, you engage in a powerful thought experiment. You imagine it is 6 months in the future and the investment has been a complete disaster. The deal has failed and the stock has collapsed. Now, you must write a story explaining exactly how this happened. What was the cause? Did regulators block it? Did financing fall through? Did a surprise competing bidder emerge? By forcing yourself to write this story in advance, you move beyond a vague sense of risk and identify the specific, concrete threats to your investment thesis. This makes the risks real and tangible, rather than abstract possibilities. Step 2 is to quantify the downside. This is the most crucial part of arbitrage analysis. Based on your pre-mortem, you must calculate a realistic price for the stock if the deal fails. What is the company's standalone value? Look at where the stock was trading before the deal was announced. Look at the valuation of its peers. Come up with a hard number. If the stock is at $96 and you believe its standalone value is $75, your downside is $21 per share, or about 22%. This is your downside cap. You know your maximum likely loss. Step 3 is to create an asymmetric profile. Now you compare your quantified downside with the potential upside, the spread, and the probability of success. You are explicitly looking for asymmetric risk/reward profiles. You want situations where the potential reward, weighted by its high probability, is significantly greater than the potential loss, weighted by its low probability. A great arbitrage bet might be a situation with a 95% chance to make 10% and a 5% chance to lose 25%. A terrible bet, even if the spread looks good, might be a 70% chance to make 15% and a 30% chance to lose 50%. You must have the discipline to walk away from these symmetric or negatively skewed bets, no matter how tempting they seem. Finally, step 4 is to adhere to stop losses based on thesis change. Your decision to sell should not be based on a price movement, but on a change in the facts that underpinned your original thesis. If your thesis was that regulatory approval was 95% likely, and a credible report comes out that the DOJ is preparing a lawsuit to block the deal, your thesis is broken. The probability has fundamentally changed. You sell. Immediately. This framework forces you to be a risk manager first and a return seeker second. It builds the discipline of saying no, and provides a clear, logical plan for what to do when things go wrong, inoculating you against the emotional plagues of panic and hope. The antithesis to this rigorous risk management is the hopeful romantic. This type of investor doesn't fall in love with a company, they fall in love with a deal. They are captivated by the story of the merger, the synergy, the grand vision. They focus exclusively on the upside, the beautiful profit they will make when the deal closes. They might calculate the spread, but they spend no time at all on the pre-mortem or quantifying the downside. Their analysis is a one-sided love letter to the deal's potential. When negative news emerges, the hopeful romantic does not see it as a change in probabilities. They see it as an obstacle to be overcome on the path to true love. They engage in confirmation bias. actively seeking out information that supports their belief that the deal will still happen while dismissing any evidence to the contrary. They tell themselves the analysts who are negative on the deal just don't understand the strategic fit, or, this is just market noise. The fundamentals of the deal are still sound. Because they have no predefined exit plan for a broken thesis, they are adrift when things go truly wrong. If the deal officially breaks, and the stock plunges 30% in a day, the hopeful romantic is paralyzed. They can't bring themselves to sell and accept the devastating loss. So they commit the cardinal sin of investing. They change their story. They say, well, I'm no longer an arbitrager on this stock, I'm now a long-term value investor. I believe in the company's standalone prospects. This is a desperate post hoc rationalization to avoid facing the reality of their mistake. They have turned a disciplined, short-term strategy into a forced, undisciplined, long-term gamble. They ride the stock down further and further, tying up capital for years in a losing position, all because they couldn't emotionally handle the consequences of a failed deal. The hopeful romantic's portfolio becomes a museum of past loves, a collection of broken arbitrage plays that have morphed into reluctant long-term holdings. It is a graveyard of capital, all because they focused on the romance of the upside instead of the cold, hard math of risk. The direct financial connection here is the concept of creating an asymmetric risk/reward profile across your entire portfolio. This is a principle used by the world's most sophisticated financial entities, from hedge funds to private equity firms. It's about engineering a portfolio where the potential for upside is structurally larger than the potential for downside. Let's visualize two portfolios. Portfolio A belongs to the hopeful romantic. It's filled with bets that have, for example, a 50% chance of making 20% and a 50% chance of losing 40%. The expected return on each bet is negative. It's a coin flip weighted against him. A string of bad luck could wipe him out. Portfolio B belongs to the disciplined risk manager. It is filled with bets that have, for example, a 90% chance of making 10% and a 10% chance of losing 30%. The probability-weighted expected return on each bet is positive, 0.90 * 10%, minus 0.10 * 30%, equals 9% minus 3% equals 6%. Each individual bet is a positive expectation wager. Over dozens or hundreds of such bets, the law of large numbers begins to work in favor of the disciplined risk manager. Even with the occasional loss, the portfolio as a whole will grind higher. This is how casinos and insurance companies make their money. They have a small, persistent, mathematically positive edge that they exploit over and over again. By applying the pre-mortem and downside capping framework, you are essentially turning yourself into the casino and the rest of the market into the gamblers. This has a massive impact on your financial statements. It dramatically reduces what is known as tail risk, the risk of a rare but catastrophic event that can wipe out a significant portion of your capital. By quantifying and capping your downside on every single position, you are effectively eliminating the possibility of a portfolio-killing blow. This financial discipline is the secret to longevity and resilience in the investing world. It ensures that you stay in the game long enough for your edge to play out, which is the ultimate key to compounding your capital and achieving financial freedom. The goal is not to be right all the time. The goal is to construct a system where you make more money when you are right than you lose when you are wrong. That is the essence of professional risk management and the financial bedrock of the arbitrager. Ultimately, the strategies of arbitrage and special situations investing are more than just a niche technique for generating market alpha. They are the investable manifestation of a much deeper philosophy, a universal tool for executive decision-making and rational thinking in any complex environment. The arbitrage mindset is a way of seeing the world, of identifying gaps between perception and reality, and of profiting from the predictable machinery of systems, whether those systems are financial markets, corporate structures, or even human careers. It's a way of thinking that elevates you from a mere participant to a savvy operator within any given system. Perhaps the most illustrative anecdote of this broader mindset is not from Buffett's partnership days, but from a much more personal business transaction: his 1983 acquisition of Nebraska Furniture Mart from its founder, the legendary Rose Blumpkin, or Mrs. B. On the surface, this was a simple acquisition, not a public market arbitrage, but in its DNA, it was a profound arbitrage play, an arbitrage of information, trust, and process. Mrs. B had built an empire from a small pawn shop into a retail behemoth with hundreds of millions in sales, all based on her simple motto: sell cheap and tell the truth. When she decided it was time to sell, she could have hired a team of high-priced Wall Street investment bankers. They would have run a lengthy, expensive auction process, shopping the company around to the highest bidder. This process would have been adversarial, complex, and filled with uncertainty. Buffett approached her with a different proposition. He had long admired her business genius. He went to her, did his own analysis of the business's value, and made her a cash offer, around $60 million, on the spot, based on a simple, one-page agreement. He didn't haggle over every last penny. He didn't bring in an army of lawyers to scrutinize every detail. He recognized the immense value of the business Mrs. B had built, and he knew that the fair auction price would likely be much higher. But what he was arbitraging was the gap between that theoretical auction price and the price at which a simple, honest, and trustworthy transaction could be completed. He understood that for Mrs. B, a straightforward deal with someone she trusted, who promised not to fire her family and to let her keep working, had a value that went beyond money. He arbitraged the inefficiency of the typical Wall Street sales process. He offered certainty, simplicity, and trust in exchange for a price that was a bargain, even if it was fair to her. He was profiting from a special situation created by human factors, not market mechanics. This demonstrates the arbitrage mindset in its highest form: seeing value where others see complexity, and understanding that the most profitable gaps are often not in financial statements, but in human relationships and inefficient processes. The psychological principle that this mindset constantly battles is the pervasive and dangerous overconfidence bias, coupled with its partner in crime, the need for ego gratification. The typical executive, the archetypal CEO, is often rewarded for projecting an image of bold, visionary leadership. They are encouraged to make grand predictions, to set audacious goals, and to believe they can bend the future to their will. This culture breeds overconfidence. They start to believe their own press releases. They believe they can predict consumer trends 5 years out, that they can flawlessly integrate a massive acquisition, or that their new project is a guaranteed world changer. This is the path of ego. They would rather fail spectacularly while attempting something grand than succeed quietly at something simple and certain. The arbitrage mindset is the perfect antidote to this toxic overconfidence. It is a philosophy rooted in intellectual humility. The arbitrageur does not believe they can predict the future. In fact, their entire strategy is based on asterisk not having to predict the future. They are not looking for visionary moonshots. They are looking for broken plumbing. They are looking for contractual obligations, mathematical certainties, and structural inefficiencies. Their ego is not tied to being a great visionary. It is tied to being a great calculator. This mindset is about relentlessly asking, what do I know for sure, not what do I believe will happen. It's the difference between a general who believes he can win the war with one heroic cavalry charge and a logistics officer who knows the war will be won by whoever can deliver the most beans and bullets to the front line. The logistics officer deals in the boring, predictable machinery of the system. The general deals in the glorious, unpredictable narrative of battle. In business and investing, it is almost always the logistics officer who wins in the long run. The arbitrage mindset is the mindset of the logistics officer. It is a commitment to the boring, the quantifiable, and the certain. It is the understanding that true success comes not from a single brilliant insight, but from the relentless, disciplined exploitation of small, high-probability advantages. It is the recognition that, as the saying goes, ego is the enemy of good returns and good decisions. So how do we apply this grander life arbitrage mindset as a practical mental model outside of the stock market? It's a three-step process for making better decisions in your career, your business, and your personal finance. Step 1. Identify gaps between perception and reality. Constantly scan your environment for situations where the popular perception of something is wildly different from its underlying reality. For example, in career planning, many people chase glamorous jobs in fields like entertainment or media, where the supply of talent is huge and the pay is often low. The perception is glamour. The reality is intense competition for scarce rewards. The life arbitrageur would look for the opposite. A career path that is perceived as boring or unglamorous, like waste management or specialized industrial welding, but where the reality is high demand, low supply of skilled labor, and consequently, extremely high pay. You are arbitraging the gap between social status and economic reality. Step 2. Find asymmetric opportunities. In your personal and professional life, actively seek out situations with an asymmetric risk/reward profile. This means opportunities where the potential upside is enormous and the potential downside is small and capped. Starting a blog or a YouTube channel on the side is a perfect example. The downside is a few hundred hours of your time. The upside, if it takes off, is a life-changing business and platform. You are applying the same logic as the risk manager who looks for a 10-to-1 reward-to-risk ratio in a trade. Most people do the opposite. They take jobs where their upside is capped at a 3% annual raise, but their downside is getting fired. The arbitrageur looks for unlimited upside and strictly limited downside. Step 3. Look for deal-like structures. Train your brain to see life not as a linear path, but as a series of events and catalysts. For example, getting a specific professional certification might require a 1-year commitment and $5,000 in tuition. But if data shows that people with that certification earn, on average, $15,000 more per year, that's a special situation. You have a known cost, a known timeline, and a high probability outcome. It's a deal with a massive annualized return. This connects directly to achieving financial freedom. It's about making a series of smart, high-probability bets with your time and money, rather than just drifting along and hoping for the best. By applying the arbitrage mindset to your life, you stop being a passive spectator and become a strategic operator, constantly looking for ways to engineer a better, more profitable outcome for yourself. The antithesis of this practical, grounded mindset is the grand visionary who ignores the details. This is the entrepreneur, the executive, or the investor who is completely captivated by their own grand vision. They talk endlessly about disruption, paradigm shifts, and changing the world. Their rhetoric is inspiring, their passion is infectious, but their grasp on reality is often tenuous. They are so focused on the mountaintop that they fail to look at the ground beneath their feet. They will launch a product without analyzing the unit economics. They will sign a partnership agreement without reading the fine print in the contract. They will hire a key executive without properly checking their references. They believe that their vision is so powerful that it will simply overwhelm all of the messy, boring details. This is the path of hubris. The grand visionary often ends in ruin. Their company burns through cash on speculative projects with no clear path to profitability. They get trapped in bad contracts that slowly bleed them dry. They are perpetually surprised by unexpected problems that a more detail-oriented, arbitrage-minded leader would have anticipated and planned for. While the grand visionary is painting a masterpiece of the future, the arbitrageur is meticulously inspecting the plumbing of the present. And in the world of business and finance, a burst pipe will sink the ship long before the masterpiece is ever finished. The disastrous consequence is that the grand visionary not only fails themselves, but they often take their employees, investors, and partners down with them. They create a wake of destruction, all because they believed that being brilliant was a substitute for being diligent. The ultimate direct financial connection of adopting the arbitrage mindset in your business and personal life is the relentless focus on free cash flow generation. An arbitrage trade is, at its heart, a perfect little cash-generating machine. You allocate capital, it is tied up for a short, predictable period, and it is returned to you with a profit. You then take that larger pile of capital and redeploy it in the next high-probability opportunity. It is a cycle of disciplined, efficient capital deployment and return. A business run with this mindset behaves the same way. Instead of pouring all its resources into speculative, long-shot, moonshot projects, it prioritizes initiatives with a clear, measurable, and near-term return on investment. It asks of every project, what is the spread? What is the timeline? What is the probability of success? This discipline creates a self-funding enterprise, one that generates more cash than it consumes. This free cash flow is the lifeblood of any successful business and the ultimate engine of wealth building. It is the money that can be used to pay down debt, invest in further high-certainty growth, or be returned to shareholders. For an individual, this mindset translates into a personal finance strategy that prioritizes savings and high ROI investments in oneself, like the certification example, over speculative spending. It's about seeing your career and your financial life as a business with you as the CEO. Your primary job is to maximize your personal free cash flow, the gap between your income and your expenses, and then deploy that capital into opportunities with the highest, most certain returns. This shift from a consumer mindset to a capital allocator mindset is the single most important financial transformation a person can make. It is the very essence of the arbitrage mindset applied to the business of your own life. It is not as glamorous as dreaming of a billion-dollar startup idea, but it is a far more certain path to achieving durable, resilient financial freedom. It is the final promise of Buffett's forgotten strategy, a way of thinking that builds wealth not through luck or genius but through the quiet, relentless, and unstoppable power of logic. You have just spent this time acquiring more than just another investment strategy. You have integrated a powerful mental tool, a new lens through which to view the entire landscape of opportunity and risk. You've moved beyond the simple one-dimensional world of buy and hope, and entered the three-dimensional world of the arbitrageur, where profits are found in the very architecture of the market itself. You now understand how to find opportunities where the return is not based on a guess about the future, but on a contractual promise about the present. This is a profound shift in thinking, a protective shield against the emotional whims of the market and the costly mistakes of the 99%. But it is crucial to understand that what you have just mastered, as powerful as it is a single crucial pillar in a much larger structure. Warren Buffett's success was not built on one strategy alone, but on a network of interconnected mental models that support and enhance one another. The discipline of arbitrage is what allowed him to build his initial capital base, but how he then deployed that capital into wonderful businesses at fair prices is another pillar entirely. The way he structures his deals, the way he analyzes management, the way he uses insurance float, each is another piece of a complex, interlocking system. The video that is now on your screen is not just another video, it is the next piece of that map. It is the link that connects the strategy you just learned to the next level of the system. It builds upon the foundation of probabilistic thinking and shows you how to apply it in a completely different yet complementary domain. The choice you have now is a simple one. You can click away, satisfied with the powerful tool you've just added to your arsenal. Or you can make the decision that separates the dabbler from the master builder. The click you are about to make is not just about watching another video. It is a conscious choice to continue your ascent, to complete your mental toolkit, to build the next level of your intellectual fortress. It is a statement about the kind of thinker, the kind of decision-maker you are choosing to become. If you are ready to forge the next link in that chain, the path forward is right there, waiting for you on the screen. Complete the map.